Inflation is a very simple concept. It's just the money supply expanding. And so the more money there is, right, that's what you're inflating. That's where the word literally comes from. Over time, the government has been very successful in changing the definition of inflation to fool the public as to its source. Because if the public understood what inflation was, they would know that it's not caused by grocery stores. You know, when Kamala Harris says it's greedy grocery stores that are causing inflation, if you understand that inflation is an increase in the money supply, well, you know it can't possibly be the grocery stores because they don't have a printing press.
Each financial crisis grows more severe, setting a precedent that escalates the risks involved in global economics. Looking back at the crises of 1998 and 2008, it's evident that we may be approaching a crisis that could exceed even the Federal Reserve's power to control. We're now uncomfortably close to the edge, where another shock to the system could spiral beyond recovery. Predicting the exact timing of such events is challenging due to the intricate nature of global finance. However, what we do know is that the severity of each crisis is increasing, compounding systemic risks. We've already witnessed this twice in recent decades. In 1998, a Russian default on its external debt sent shockwaves through global markets, bringing the system to the brink. Major markets worldwide nearly collapsed, and only quick action by the Federal Reserve, including an emergency rate cut, prevented complete disaster. Long-term capital management, a hedge fund that held over $1 trillion in derivatives, found itself at the epicenter of this crisis. While their direct losses in Russia were relatively modest, the ensuing liquidity crunch wiped out billions in other assets as investors scrambled to sell everything, leading to margin calls and a sell-off across markets. Fast forward to 2008. We all remember Lehman Brothers' collapse on September 15th, but the risk was far more widespread than that one company.
Lehman Brothers is going bankrupt, and financial markets from Asia to Europe are doing their utmost to prevent Monday from turning from dark to black. Employees of America's fourth largest investment bank saw the writing on the wall late Sunday after talks to pull them back from the abyss collapsed. The U.S. government said it won't bail out Lehman, which last week announced more than $3.9 billion in losses. Shares in Lehman Brothers have plummeted more than 80% in 2008 alone.
Lehman, like so many other investment banks and banks, really got, quite frankly, caught up in the housing bubble. But like every bubble, the bubble ended, and now we're seeing the downside of that bubble.
Following the same risky practices that sunk former giants Fannie Mae and Freddie Mac, Lehman also had a hand in securing America's high-risk subprime mortgages.
Is where you're trying to solicit buy-side on these events, and you didn't know who was going out of business, who was going to be saved. We all, I am sure, I had friends that worked at Lehman. It was a dire time, and we recovered. And we look back on it where the financial institutions are stronger than they've ever been. And hopefully we don't go through another period like that again.
We were on air. I mean, I remember it well. And this is like we've chronicled so many times here on Fast Money. Wall Street's not the same, though. And there's no question that the dealer community, if you think about also the lack of the size of the book, the risk that's being taken, the size of the balance sheets, maybe this is good, some of it's bad. I think there's a lot less liquidity on Wall Street than there used to be at a time when, we may start to see more volatility shocks. So very sad day. Obviously, tremendously talented people. Wall Street has contracted dramatically from that point. Some of those changes were already happening. Some of those changes were clearly accelerated by Lehman.
The two things that are important, of course, is that the VIX, right? So the market makes its low in March of 09, but the events associated with September and October were actually the peak in the VIX, right? So that was the biggest fear moment. You had one of the biggest weekly drops. And then, interestingly, from that point to present, 15 years later, the investment banks as a group are underperforming the S&P. So adjusted for beta, it's just still
15 years later.
The S&P 500 investment bank and brokerage group underperforming the market calls into question, are those good business models, at least maybe to work there, but to be owning the shares long term, probably not.
Major institutions like Morgan Stanley and Goldman Sachs were teetering on the brink, with dominoes falling in rapid succession. The Federal Reserve once again intervened, acting as the ultimate backstop. But each bailout has only been a temporary fix, and with every intervention, the stakes and potential costs have only grown. Now, as we look toward the future, each new crisis looms larger. Investors and institutions are increasingly seeking safe havens, assets that may be shielded from global liquidity crises. Real estate, gold, silver, and other tangible assets like fine art have become valuable in times of financial instability. As we saw with the soaring valuations of assets like Andy Warhol's works, these assets hold value independent of traditional market fluctuations, often becoming more desirable as uncertainty mounts. In contrast, regular stock portfolios and bank holdings are highly susceptible to liquidity crises, with money market funds and banks facing intense pressures when liquidity dries up. Even the dollar, historically a safe haven, is becoming a concern. In many ways, the dollar has functioned like a cryptocurrency since 1979, with digital, encrypted messaging and financial transactions becoming the norm. The confidence in the dollar may soon face challenges from international sanctions and a shift away from the US-dominated financial system. Recently, economic sanctions, which can be highly effective, have been applied too frequently and broadly, reducing their impact. Rather than succumbing, targeted countries like Russia and Saudi Arabia are exploring alternative payment systems. Even major US allies are beginning to question the dollar's safety, as seen with recent sanctions that froze assets of Russian oligarchs, Canadian truck drivers, and others deemed politically contentious. For many, these sanctions have highlighted a critical vulnerability in relying on the dollar-dominated system. Countries and wealthy individuals, previously unfazed by US policies, are now reevaluating their financial dependencies. Saudi princes, for example, who hold significant assets in the US and Europe, are now aware that their wealth could be seized with a policy shift. This concern is not limited to billionaires. Even middle-class Canadians experienced asset freezes. Such incidents are making global investors, especially in countries like Russia and China, look for alternatives to the US dollar. In recent years, both Russia and China have strategically increased their gold reserves, each quadrupling their holdings since 2009. This accumulation of gold is a deliberate move to reduce dependency on the dollar. However, while some speculate about the Chinese yuan potentially replacing the dollar, this is unlikely. The yuan lacks the bond market infrastructure, liquidity, and legal framework that underpin the dollar's dominance. In fact, China's financial system lacks the rule of law required for global trust, making it a poor candidate as a reserve currency. Yet the possibility remains for an entirely new system to emerge, one that could challenge the US-centric financial order. In theory, a multinational coalition could establish a new currency backed by gold and held in third-party reserves. By leveraging trusted jurisdictions like Switzerland and enforceable contracts under UK law, this currency could provide the stability and security that many believe the dollar is starting to lack. However, while feasible, such a system is not imminent. In the short term, confidence in the dollar and the international monetary system could falter. Historically, the global financial system has collapsed 3 times in the last century, in 1914, 1939, and 1971. Each collapse was followed by a renegotiation of the monetary framework, most notably at Bretton Woods in 1944. If the dollar-centric system falters, we may see another global conference aimed at re-establishing financial order, possibly shifting toward a system with multiple reserve currencies, or even a return to a gold-backed standard. There are 4 main paths the future could take: a world of multiple reserve currencies, the dominance of IMF-issued special drawing rights, SDRs, a return to a gold standard, or most likely a collapse followed by systemic changes. A multi-currency reserve system is an idealistic solution, but ultimately unstable without a central anchor like the dollar or gold. With several currencies competing for dominance, currency wars could intensify, undermining global stability rather than reinforcing it. The second scenario, favored by global financial elites, involves the IMF's SDR, effectively creating a new world currency. The SDR, though little understood, is essentially world money, and the IMF has a plan to expand its role in global finance. This transition has been gradually creeping into our system, with the US Treasury providing substantial financial backing to the IMF, much of which has been used to support European economies. This suggests that the IMF, rather than individual nations, could take a larger role in stabilizing global finance, though this too has its critics and limitations. A return to the gold standard, the third scenario, would require fundamental changes. a gold-backed currency could stabilize global finance. But questions remain about how much gold would be needed and which countries would participate. The United States and Europe hold significant gold reserves, and a cooperative gold-backed system could give these regions a powerful voice. However, China's rapidly growing reserves also give it a major stake, complicating any negotiations. The final and perhaps most realistic scenario is a financial collapse resulting from policy missteps, a failure to account for systemic risks, and escalating economic tensions. Should a collapse occur, governments may resort to drastic measures, potentially leading to forms of economic authoritarianism. Inflation and deflation, typically opposing forces, could combine in a volatile mix, with deflation driven by debt reduction and inflation fueled by monetary policy. This tug-of-war between inflation and deflation can create a precarious equilibrium, one that could snap at any moment, pushing the economy into either rapid inflation or deep deflation. Monetary policy, particularly the velocity of money, plays a crucial role here. Velocity measures how often money changes hands, fueling economic activity. If people are reluctant to spend, velocity drops and the economy stalls, regardless of the money supply. The Federal Reserve's strategy hinges on boosting this velocity, aiming to spark spending through tools like negative real interest rates and inflationary shocks. By keeping interest rates low and nudging inflation higher than expected, the Fed hopes to encourage borrowing and spending. This tactic is a form of behavioral manipulation, a psychological effort to boost economic activity. However, achieving sustainable inflation is a complex challenge. Governments rely on inflation to fund operations, as it allows them to tax income increases. In a deflationary scenario, where prices fall but incomes stay stagnant, governments struggle to capture this increase in purchasing power through taxes. Inflation thus remains a priority for policymakers, who view it as essential to maintaining fiscal health and public programs. As we move forward, it's clear that the global economic system is under stress. Central banks and governments may delay the inevitable through interventions and policy adjustments, but the fundamental vulnerabilities remain. Whether through a multi-reserve currency system, the IMF's SDR, a new gold standard, or a reset following a crisis, the future of global finance is poised for a dramatic shift. This evolution will not only reshape markets, but also redefine how nations interact and wield economic power. Ultimately, the choices we make now will determine whether we merely postpone the next crisis or pave the way for a truly sustainable financial future. Like and subscribe to bring good luck and blessings for your financial future and get this crypto bull run going.